moving on to my session, which, as I said, is an overview of the new laws. This is a list or summary of those new laws. There's the transfer balance cap, the changes to the non-concessional contributions caps, the changes to the transition retirement income streams, changes to the concessional contribution caps, the new catch-up concessional contributions measure, the abolition of the 10% test, the reduction of the Div 293 threshold, the abolition of the anti-detriment rule, the tax offset for spouse contributions, etc. So what I won't be talking about in too much detail in my presentation is the non-concessional cap, the changes to the TRIS measures as they'll be dealt with in Melissa's session, and also the cost base reset for the transfer balance cap, which will also be dealt with by Melissa, and death benefits obviously will be dealt with by Rob. Now moving on to the main measure, or probably the key measure in relation to creating a new regime, and that's the new transfer balance cap regime. That, as I'm sure most of you, if not all of you, are aware, is the new $1.6 million cap on amounts you can hold in pension accounts in the fund or in a fund. It includes a start date of 1 July, which means that anybody who has currently pensions over and above that 1.6 million will have to commute their existing pensions back to 1.6 at 30 June. Importantly, and this is there's some confusion, especially with clients, is there's no change to the taxation of benefits. Benefits are still tax-free. This is all about how the fund itself is taxed. That said, there is a caveat to that absolute statement, and that is that there is a change to the tax treatment of market-linked pensions and defined benefit pensions. But for your account-based pensions and your accumulation accounts, your pension payments, your lump sums that come out of the fund, if you're over 60, they will continue to be tax-free. So as I said, the changes are more about how much you can actually hold in pension phase, how much of the income and capital gains are taxed at 0%. Because that will have a retrospective effect in the sense of taxing capital gains that under the current regime potentially wouldn't attract capital gains tax, there is this cost-based reset which allows or is designed to have the effect so that only future growth is taxed, and any growth, any capital growth prior to 1 July is effectively tax-free. And as Mel will talk about, that doesn't always work 100%, but it is a welcome measure, and it's something that was a bit of a surprise packet when the government announced or actually released the details of the changes. In relation to measuring the cap, there's two concepts that we now have to consider, and two additional jargon. So the new super laws have introduced an incredible number of definitions. I should have gone back and checked it, but it's something like 22 new definitions. So that's 22 new concepts that we as professionals have to get our heads around, at least in relation to using terminology. So two of those are the transfer balance cap, which everybody or most people are aware of. That's the 1.6 million. But there's also the transfer balance account. So your cap is the maximum you can have in your account. Your account is actually how much you've got in your pension account, which is under this new concept of credits and debits, the net value of credits and debits. So how do we actually measure the cap itself? How do we calculate the account and measure it against our cap? The first, the concept or how that's measured is this new concept of credits and debits. It's not credits and debits in an accounting sense, it's credits and debits in a bank account sense. So credits are amounts that increase your account and consequently reduce your cap. So they'll include any existing pensions at 1 July 2017. So at 1 July 2017, we see how much we still got in pension account. If we've got $1 million in pensions, then that's $1 million that goes towards our account, and therefore we've got consequently 600,000 left in our cap. It'll also then include new pensions commenced after that date. So any new pensions will again added to it. So in that example where we've got $1 million at 1 July, if we add another pension a year later of 200,000, that's another credit to our account. So now we've got 1.2 in our account and 400,000 left in our cap. And importantly, and this is a big change, or result potentially a big change, death benefits or reversionary pensions that are commenced to be paid to you will also be counted towards as credits towards your account and towards your cap. And as Rob will explain, that changes a lot of our planning. No longer can we necessarily just pay 100% of the pension to our spouse. We might have a liquidity event or an obligation to commute out a pension upon the death of the first. Then we've got the concept of debits. So these are amounts that reduce your account and consequently increase your cap. So they will include amounts commuted as lump sums. So if you have $1.2 million in your transfer balance account and you decide to take a lump sum of $1 million, then that's a debit and your account goes back to 200,000 in that example, and you can make further contributions. Importantly, it doesn't include pension amounts. So if any amounts that come out as a payment of a pension payment, they will not come off your account or your cap. And it doesn't include investment losses. So the fact that your member account balance goes up and down won't affect the amount in your cap. There's a very valuable exemption for structured personal injury settlements, albeit that's going to be fairly rare. So that's really where you've got clients who've suffered an injury, they've got a big payout and they've put that into their super. That is very concessionally taxed or concessionally treated in this transfer balance cap regime. But that said, we're not going to see too many of them, and hopefully for your clients' sake, you're not going to see many of them. There's also debits for bankruptcy clawbacks. Again, this is going to be fairly rare. In fact, I've never seen a bankruptcy clawback, but in the bankruptcy laws, there is the ability to claw back large, unusual contributions. If that does occur and that amount has gone into your pension account, then you get a debit to your account. What's going to be more likely to be seen in practice is family law payment splits, so that any situation where you've got a divorcing couple which results in someone having to pay out super to a spouse, that will be reduced from their as a debit to their account, which means importantly they can make future contributions to their pension account. And another rare one there at the end is amounts lost to fraud, which again doesn't happen very often and is actually quite difficult to satisfy in that provisions. Basically the person who committed the fraud has to be convicted, so it's not going to be happening very often. So what the important thing to note about these credits and debits, it's the amount you put into the pension or take out of the pension, so put in as starting a pension or receiving a death benefit, or take out as a commutation or take out as a family law split. It's not the movements up and down. So it's not investment returns, it's not pension payments taken out. So if you start at 1 July, you've got you commute back your pension to $1.6 million, and then you invest really well, and that pension account turns into, say, $5 million, that's your pension. You don't have to commute back to 1.6. It's just the amount you put in. If you put in and goes really well and increases to $5 million, that's still in pension phase, that stays in pension phase. Conversely, if you invest really poorly and your 1.6 turns into 100,000, you don't get a chance to top it up. It's bad luck. So that's where you can see that there is a bit of planning around, well, how can we make sure that our growth investments are in the pension account? And Melissa will talk a bit about how we can do that. The new measures, as you're probably all aware, are complex, and they delve down into levels of complexity that Treasury didn't have to go to, but they've decided to do it. And the proportionate indexation is one of those examples. So the cap's 1.6 million, as we know, at 1 July 2007. There is the ability to, or it will be indexed in 100,000 increments, albeit the indexation is CPI, so it's not going to happen in a hurry. But when it does increase by that, from that 1.6 to 1.7, it's not that everyone gets the 1.7. You only, if you've already started the pension, you only get a proportionate increase in your cap. So this is best explained by example, as I've got up there in the slides. So let's say you use 60% of your cap, so you've only got 40% left. The general cap increases by 100,000 from 1.6 to 1.7. In this example, your cap will only increase by what you've got left in the cap, so 40%, so that's $40,000 out of the 100,000. So for this person, their cap is 1.64 million. So you can see that everybody who started the pension once indexation occurs will have a different cap. So it's just going to be a nightmare, and this is where, you know, advisors will be under the gun to keep these records. The ATO will, they say they'll be able to keep records, but, you know, so that's you know, that's unfortunate, but that's another level of complexity. That said, indexation is not going to happen for 5 years. And we all know every time something comes up to be indexed, the government invariably freezes indexation or something. So maybe we'll never have to worry about this, but as it is, that's something to think about, at least in the future. So that's the cap. Well, what happens if you actually exceed the cap? So what if you don't commute back your pension to 1.6 and you keep your $2 million pension, or you start a pension over and above your 1.6, which might happen with people with multiple funds. What it does is it triggers the excess transfer balance tax regime, which is very similar to the new regimes for excess contributions, in that they have these notional earnings amounts. So the excess amount will be subject to notional earnings, which is effectively an interest rate that matches what those, in lieu of those earnings. It's only those notional earnings that are subject to the excess transfer balance tax. The rate of tax on those is a flat 15% for first offences and 30% for subsequent offences. In addition, anybody who exceeds their transfer balance cap will be obligated to commute out or take out that excess amount plus the earnings amount. And as a sort of a sting in the tail, if you refuse to comply, if the super fund refuses to comply with that obligation to take the excess amounts out, then that pension or that fund will be out of pension phase for that whole year. So that's an additional penalty at the fund level. Cost-based reset, which I won't go into because that's what Melissa will talk about, but that's, as I mentioned, to help alleviate the retrospective measure. So that, in a very short summary, is the transfer balance cap regime. Moving on then to the next measure, which is the reduction of the concessional contribution caps. This will have a wider effect, albeit there's not a lot that can be done with these. The current caps of 30 and 35 will reduce back to a flat rate or flat cap of 25,000 per annum. The current regime where there's a special cap for members aged 50 plus will go on. It's just a one flat measure for all. Indexation, the indexation amount will be lowered from 5,000 to 2,500, which is welcome in the sense of indexation will happen more often. That said, we've had the new contribution caps since 2007. It's only indexed once. And that's because every time it gets close to indexation, the government freezes indexation. So at least that hopefully will mean that indexation happens. There's the new catch-up concessional contributions measure. That will apply from 1 July 2008. That was initially due to also start in 1 July 2017, but was pushed out due to some of the horse trading. But that's when the actual measure starts. So this is the measure that allows you to basically catch up 5 years worth of concessional contributions. So if you go back over your last 5 years, see how much you're under the $25,000 cap, and you can catch up effectively what you have missed out the last 5 years. But because it actually starts in 1 July 2018, and then it works prospectively, not retrospectively, so no one will have unused concessional contribution caps until the 2019-2020 year. So this measure is a long way away, but something to keep in mind. The other thing that really puts a brake on this measure is it's only available for people who have total superannuation account balances of 500,000 or less on the previous 30 June. So it's a fairly targeted measure at, I guess, people with low income balance or lower balances, I should say. In relation to measuring that 500,000, like a lot of the new law, it's complicated in relation to how it's actually been drafted. The notion of total superannuation balance has these three elements, which is accumulation phase value, transfer balance account adjusted by market value, and a rollover benefit in transit. You know, to cut to the chase and all that gobbledygook, it's basically what your account for most super funds, SMSFs or large funds, it'll just be your account balance, and that rollover transit thing is just in case you've rolled over a benefit, and it's sort of in limbo between 30 June, so effectively is your account balance. Now Labor proposes to abolish this measure, so this one might not see the light of day, and it's certainly a lot easier for new governments to abolish measures that never have got into place, so to watch this space for this measure. The abolition of the 10% test for personal deductible contributions. So this there's a lot of doom and gloom in all these measures, but this is a very welcome one. Under the current regime, basically employees can't make personal deductible contributions because more than 10% of their salary or wages or assessable income is salary and wages. So all they can do is salary sacrifice, which may not be available to them, or alternatively is quite difficult to do unless you do it well in advance. So this will mean that members outside of their employment can actually make contributions and get deductions for them. The notice requirements haven't changed, so part of our submissions that we made to the government in relation to this measure was, yeah, we welcome it, but it'd be nice if some of those notice requirements were streamlined and didn't have us drop dead dates like they currently do. So Treasury wasn't really receptive to that, but since that, the government has announced that they're happy to at least look at those processes. Again, this is another one that Labor proposes to abolish, so we'll see where that ends up. Then briefly over the rest of the remaining measures, we've got, as I said, the reduction in the Div 293 threshold. So that's the rate at which concessional contributions are taxed at 30%. So currently that's $300,000 from 1 July, that'll be $250,000. And this is one of those measures that I'm sure you see clients just getting random assessments and they just have no idea about it. So this is always a bit of a sleeper, and every time you lower the threshold like this, it'll bring more of your clients into the net. And because this works basically until you have to lodge your tax returns, it's 18 months later, or 18 months after the end of the financial year, potentially, before these notices start going out. So it's one of those things that the clients are never happy and don't understand. So it's possibly something that you can alert them to at least get them to know that this might be coming to them in the next couple of years. So TRISs are no longer eligible for pension phase, so Melissa will talk about that in a bit more detail. The abolition of the anti-detriment rule, which doesn't really affect SMSFs too much, and in relation to some of the other rules, it's probably on the margin, but some people really love it, and certainly some of the larger funds do it, so that'll be obviously disappointing to some people, but it's fairly marginal, as I said. The tax offset for spouse contributions has increased from 13 or just under 14,000 to 40,000. So that just means more people can make tax offset spouse contributions for spouses and get a deduction for them. The low income superannuation tax offset is being reintroduced, although this is effectively the old measure that Labor had that was abolished, so that effectively is a refund of concessional contributions or contributions tax paid on SG amounts for our employees who are under $37,000 of income. And there's also the ability, or there's these new laws that will allow innovative income streams or deferred annuities, unlikely to be seen in the SMSF sector, but has been put in there to allow larger funds in particular to offer particular annuities where a member will buy it, but it doesn't kick in until they reach, say, 80 or something like that. And the whole idea of that is that it will kick into pension phase when you buy it, not when it actually kicks into pension phase. And just lastly, which is not on that slide, is the object of superannuation. So the government has enacted a bill to, has proposed a bill to set what is the object of superannuation. And I was, through the Tax Institute particularly, strongly involved in relation to giving feedback or trying to get that that bill amended. Unfortunately, it seems to fall on deaf ears. And the reason that we were really strongly against that bill is that they've tied the object to super to the age pension, which we thought was a low bar. The whole idea of this purpose of superannuation was to create a bill in which government had to say, we have to review, every time we make a change to superannuation, we have to look at what's the object of superannuation. And our view, in almost all the industry's view, was that if you tie it to the age pension, basically any changes can be made, because you can say, well, any of these concessions are more than what people need to be on the age pension. So unfortunately, that's where it looks like it'll head. But anyway, as an industry, we certainly had a go at trying to get that changed.